Hi dear audience, my name is Alexey. In this video we will discuss why we need a trading plan and what main points it should contain for successful trading in the market. Chaotic and systemless trading is a kind of gambling, and in the long term such approach guarantees loss of funds and has nothing to do with trading. Each trader who is responsible for the trading process must follow the clear principles when entering and exiting the market. Therefore, each trader needs a trading plan, and now we will analyze its key points. First of all, it's necessary to understand if it is worth trading on this financial instrument. If you see the market is in a trend, rises actively or declines, impulse and corrective waves are formed, then this is a trading market and you may trade. Otherwise, if the market is in a flat or in a triangle, in other words, when the market is in a narrow price range, then you shouldn't trade, and you have to wait until the market gets out of this condition. The next point of the trading plan is the determination of the direction for trading. As we discussed in the previous videos, the direction of the breakout indicates the direction of the trend. This is the first property of horizontal levels. Therefore, the last broken level indicates the direction in which you should trade. In addition, you need to understand where the potential market entry and exit points are. Therefore, you have to decide which trading tactics is close to you, breakout or rebound trading. When the breakout trading, the search for an entry point is carried out above the resistance level or below the support level. Once the market is closed and the important level is updated, it becomes possible to open a position in the breakout direction. The second tactic is the rebound trading. In this case, you ignore the breakout signal and wait for the correction. Only after its completion and the rebound candle formation, you should determine the entry points, that is, on the current or smaller time frame. In order to understand whether it's worth opening a position when a breakout or rebound signal appears, you have to determine potential targets and understand when to exit the market. You should also take into account which marks the price can reach, where the movement can stop, and at which point the loss must be fixed if the market goes in the unfavorable direction. In this situation, the properties of the horizontal levels, which we analyzed earlier, can help us. Apart from this, each trader should take into account risks in his trading plan. Before opening a position, you must clearly understand what maximum level of risk is acceptable in each trade, as a percentage of your trading capital. Let's take a few examples and see how exactly the levels help determine the targets and market entry points. The first asset that we will examine is silver, the daily time frame. We have a bull trend. If we were trading this trend, we would close some positions, and a correction or a market reversal could be expected. On March the 2nd, a huge bear candle is formed, which breaks through the support level that was formed a week before. The borders of this level are from 17.82 to 17.94. After the candle closing, a sell breakout signal was formed. The market was closed in bear condition, which means that the bull trend ceases to exist and the bear trend is dominating now on the daily time frame. Traders who trade breakouts understand at such moment that the market has formed a potential entry point. However, whether to open a position or refrain from entering the market depends on what risks to take and what is the profit potential. When opening sell positions, the targets are the support levels. In this case, the next support level was formed at the end of January after the bull candle formation. This candle overlapped 3 previous bear ones, which means that we can plot a completed support level. The upper border is 16.74, the lower border is 16.63. Before opening a position, you have to determine the market exit points. Defense stop-loss orders when opening a bearish position are usually placed above the nearest resistance level. The level is in the range of prices from 18.48 to 18.39. We have determined the point for a stop-loss placement. Now it's necessary to estimate the market movement potential. The potential profit is desirable to be at least twice the risk, and the risk-reward ratio should be at least 2 to 1. The target determination for the full or partial close of the position can also be based on the levels, as according to one of the properties of the levels, the price will be more likely to rebound from the level than it will break it through. This is especially true for large time frames, for instance, the daily. There is a potential for the movement, but as the market approaches the target, it can slow down, transform into a flat or a triangle, and the correction can start. If the price does break through the support level, the next targets can also be determined according to the nearest levels. In our situation, such target is around the levels formed at the end of last year. The lower border is 15.61, the upper border is 15.72. You can use as target the first, second, or third level of the current time frame or the nearest level of the larger time frame. Having plotted the horizontal levels, it's possible to understand where it's necessary to place a defense stop-loss order and the order for profit fixing, that is a take profit. Before entering the market, I recommend you to estimate possible risks and profit potential. Not each breakout or rebound is noteworthy. Situations are different. The price not always moves linearly after the level breakout. Often correction starts after one or two candles. In our situation, the correction lasted only during one day. After that, the market dropped down. After the breakout, the price sometimes moves in the direction we need. However, after this, ambiguous situations can take place. It means that the price is at one point and the flats and the triangles can appear. In such situations, you have to replot the levels. If the price is fluctuating between newly formed levels for a long time, I recommend you to close positions. Let's take one more example. New Zealand dollar, the daily time frame. The support level was formed on the market. The lower border is 0.7222, the upper border is 0.7242. The bull movement ended up overlapping and the level was formed. After that, the price was rising for some time, but on February the 9th, the market was closed below the support level. This means that in terms of technical analysis, the trend has reversed and the bears dominate in the market now. The question is, what to do in this case? After the candle closing, a level breakout signal has been formed. This means that traders who prefer such trading tactics can open the sell positions. However, the question arises whether to enter the market or not. Search for the nearest resistance level where defense orders are set can help us. A reliable stop loss when opening a sell position is always placed above the upper border of the resistance level. If the price mark is about 0.7375, then the stop loss can be set around 0.7385. The next question is how to determine the target. In the previous example, we determined the target on the daily time frame, which was used to seek for the market entry point. However, time frames of a higher value are often used to determine targets. For example, when trading on the daily time frame, the target is determined by the weekly one. The nearest support level of the weekly time frame is the potential target, which is in the area of 0.6866. This is the upper border of the level. You can fix profit at this point. If you trade on the daily time frame, you can place take profit orders in accordance with daily targets, which will often coincide with the weekly ones. But in order to see a complete set of prices for setting targets, you have to plot levels on several time frames. Anyway, when entering the market, you have to calculate the profit and risk potential to understand where the position will be closed if the price moves against you and where it's necessary to fix the profit. Having determined the targets, you can calculate the potential risk-reward ratio. If the risk-reward ratio is at least 2:1, this is a good position. If we traded only on the daily time frame and didn't see larger time frames, then the first target would be closer. I recommend to indicate the first target on the current time frame. In this example, it's the daily time frame, and after that I recommend to look at the targets plotted on larger time frames. Let's summarize. A good trading plan contains the principles of entering and exiting the market and algorithm for determining the trend direction and setting targets. Apart from this, the trading plan should contain requirements for the minimum risk-reward ratio and the principle of the position volume determination.